Hello and welcome. Have you ever seen a bank's stock price just go on a wild ride and you're left wondering what on earth is going on behind the scenes? Or maybe you've just felt that trying to analyze a bank is, well, way more complicated than looking at a regular company. If that sounds like you are in exactly the right place. Today we're going to pull back the curtain and demystify it all. We'll give you a really clear framework to check the health of a bank so you can look at these financial giants with the sharp eye of a truly informed investor. All right, let's get into it.
We hear about a bank's profits all the time, every quarter, but honestly, that's just the tip of the iceberg. The real question, the one we're really going to dig into here, is what actually makes a bank a solid, safe investment? I'll give you a hint. The answer isn't just in the profit and loss statement. It's hidden in the unique risks and the strengths that are built right into their business model.
So, to get to that answer, we've laid this out like a complete health check for a bank. First, we're going to tackle the single biggest risk factor, the health of their loan portfolio. Then we'll look under the hood at the bank's core engine, its deposits and loans. After that, we'll cover the regulatory safety net that's supposed to keep everything stable, take a peek at future growth indicators, and then we'll wrap it all up with a super handy investment checklist for you.
All right, let's kick things off with Section 1. The absolute heart of any bank's risk profile is its loan portfolio. Think about it. A bank's main job is lending out money. So its biggest risk, by far, is that money not coming back. That's why understanding the quality of those loans is so critical.
So how do we measure this risk? Well, it all starts with a term you've probably heard before, non-performing assets, or NPAs. Let's break it down. For you, a loan is a liability, right? It's a debt you have to pay back. But for a bank, your loan is an asset. It's supposed to be on their books, earning the money through interest. So what happens when a borrower stops making payments? Well, that asset stops performing. It goes from being an income generator to just dead weight on their balance sheet. Now, to really get a handle on this, we use a few key numbers. The very first one is the gross NPA, or GNPA ratio. This is the big picture view. It takes the total value of all those bad loans and tells you what slice of the bank's entire loan book they represent. And of course, the lower this number, the better. It's a quick signal that, overall, the bank has a pretty clean book of business.
But wait, the gross NPA doesn't tell the whole story. See, smart banks know that some loans are just bound to go bad. It's part of the business. So they're required to set aside a kind of rainy day fund for these expected losses. This fund is called provisions. The net NPA, or NNPA, shows you the value of the bad loans after you subtract that rainy day fund. This number is huge because it reveals the actual uncovered risk the bank is still facing.
And that leads us perfectly to our third metric, the Provision Coverage Ratio, or PCR. This one's pretty straightforward. It tells you exactly how much of the bad loan pile is covered by that rainy day fund. A high PCR is a great sign. It means the bank is being careful, it's being conservative, and it's well prepared for potential losses. Just a little tip here, if you see a bank's PCR suddenly shoot up one quarter, it's worth digging into why. It could be a good sign, they're cleaning house, but it also tells you there was a pretty big mess to clean up in the first place.
Now, check this out. What's really cool is seeing how these three numbers tell a story together. Let's look at this example for Bank A. The gross NPA of 2.5% shows us the size of the total problem. But then look, they've set aside provisions, and that brings the net NPA all the way down to a much healthier 0.8%. Finally, the PCR of 82.8% tells us they've covered almost 83% of their bad loans with that safety fund. See? Looking at all three gives you a full 360-degree view of the bank's asset quality.
Okay, let's move on to Section 2. Now that we've got a grip on the risks, let's look at the bank's engine room, its core business of taking money in as deposits and lending it out as loans. This is really where a bank's profits are either made or broken.
You see, a bank's engine runs on deposits, but not all deposits are created equal. First, you have CASA deposits, that's current and savings accounts. And let me tell you, this is the holy grail for a bank. Why? Because the interest they have to pay on this money is practically zero. It's incredibly cheap funding for them. On the other hand, you have term deposits, like fixed deposits, where they have to pay out much higher interest. So as an investor, one of the first things you should hunt for is the CASA ratio. A high CASA ratio means the bank's raw material, money, is cheap, and that directly fuels higher profits. Simple as that.
So where does all that cheap money go? Well, let's look at the loan book. A bank with a ton of retail loans, home loans, car loans, credit cards, is spreading its risk out. If one person defaults, it's a tiny dent.
But corporate loans, that's a different game. They're these huge concentrated bets on just a few companies. Yeah, they can grow the loan book fast, but if one big client goes under, it can blow a massive hole in the bank's finances. That's why, generally speaking, investors tend to feel a bit safer with banks that have a strong, diversified retail focus. A healthy mix is always key.
Okay, so we've talked risk and we've talked about the core business, but what happens if there's a real crisis? That brings us to Section 3, the regulatory safety nets. These are the rules of the road designed to make sure banks stay stable and can always give depositors their money back, even when things get rocky.
Regulators make banks follow two key liquidity rules. The first is the cash reserve ratio, or CRR. This forces a bank to keep a slice of its deposits, maybe around 4.5%, in pure cash with the central bank. No touching it. This is the absolute first line of defense if a ton of depositors suddenly want their money back. Then there's a second, even bigger buffer, the statutory liquidity ratio, or SLR. This requires banks to hold an even larger portion, say 18%, in super safe, liquid stuff like gold or government bonds that can be sold in a heartbeat. Together, CRR and SLR create this powerful two-layered defense system for the bank.
All right, moving right along to Section 4. The numbers we've talked about so far are great for telling you how healthy a bank is right now. But as investors, we're always trying to look around the corner, right? We need to know if it's built for the future. And for that, we have to look beyond the balance sheet.
Look, in today's world, digitalization is everything. It's not some cool feature anymore that makes a bank stand out. It's basic table stakes. It's what we call a hygiene factor. A bank that isn't pouring money into its digital channels for opening accounts, for booking deposits, for approving loans, is just going to get left in the dust. And it's not just about having a flashy app. You need to read their reports. Are they grabbing more market share in key areas? Are they launching cool new products? Digital is the foundation, but these are the real signs of sustainable future growth.
And that brings us to our final section. I know we've covered a lot of ground, so let's boil all of this down into a simple but really powerful checklist that you can use every time you look at a bank.
So here it is, your 5-point health check. First, asset quality. Don't just look at one number. Check the trend over several quarters for GNPA, NNPA, and PCR. Is it getting better or worse? Second, funding cost. Hunt for that high and stable CASA ratio. Third, peek into the loan book. Do you see a healthy, diversified mix? Fourth, liquidity. Just make sure those CRR and SLR buffers are comfortably in place. And finally, future-proofing. Really assess their digital game and what else they're doing to grow. This checklist right here covers the absolute criticals.
So there you have it. We've unpacked the core metrics you need to analyze a bank, moving way beyond just surface-level profits to understand what makes it truly healthy and resilient. You now have a solid framework to look at any bank like a pro. The only question left is, which one are you going to check out first?